Hi, my name is Norm Miller, and I am going to talk to you about a land residual analysis approach to valuation. We're going to look at this spreadsheet that is based upon Algonquin's land residual analysis of a retail development. It's a backdoor approach in that it starts with rents and it tries to estimate what costs are supportable, and included in those costs are the cost to build, and whatever's left over in this case is what we assume the land is worth. So let's take a look at this spreadsheet. We have our base assumptions right here. Here's our square feet of a proposed development, and here's the rent that we think that we can get. Here's a low on the rent and a high on the rent in terms of what we think the market would support. So we calculate out the potential rent on the property. We add common area maintenance and insurance reimbursements, property tax reimbursements, administrative fee for the CAM. So our gross income estimate before vacancy is provided there. We have a vacancy estimate here that goes from 0 to 15%, most probable 5%. So we subtract that vacancy estimate to get the effective gross income there. Now this is all per square foot in terms of these assumptions on operating expenses, but the results are provided here for common area maintenance and insurance. Real estate taxes, you can see, run $3 a square foot. Accounting, which is a fixed fee. Management based on 4% of collected rents. It's 5% of gross here approximately, but it goes from, well, I don't have a range in here for management. So we have a reserve for replacement each year at 10 cents per square foot, and you get a resulting total operating expenses here of just under $2.5 million. So this is nothing but a pro forma that starts at rents and moves on down. And continuing to move on down, we have an estimate of NOI of $7.764 million. $7.76 million. Now the next question is, what can we support with that? Well, below here, beginning in line 22, number 22, I have an assumption on how much it would cost to buy the land. I put in $40 million because that's what they're asking. Now what's it really worth? Well, let's figure that out last. We do have hard costs to build this retail center, and it's based on cost per square foot times the number of square feet and the gross building area, but the estimate is $45 to $50 million, and I put in here 47 as most probable. We have soft costs, which would be detailed from our estimates of architecture and engineering, financing, carrying cost, legal fees. All of those type of costs would be in the soft costs, from $12.5 to $13.5 million. So we have a projected total cost of $100 million. Now, again, what can we support with this $7.76 million NOI? Well, that depends on the mortgage rate, which we're going to assume is 5.5% with a 25-year amortization term, and we have a mortgage rate assumption range here, 5.5 to 6.5. And based on this interest rate and this NOI and this debt coverage ratio, 1.3, if I divide the 1.3 into 7.76 million, I'll get this number right here as being available for debt service. That is nothing but the NOI divided by the debt coverage ratio. Now, what will this support in terms of a mortgage? Well, if I divide that by 12, I'll get the annual mortgage payment. And if I solve for what that the monthly mortgage payment, and if I solve for what that monthly mortgage payment would support in terms of a mortgage, we get a number like this using 81 or of $81 million approximately. So I took this NOI, divided it by 1.3 to say this is available for debt service, divided that by 12, solved for the present value, and I get $81 million. Now it turns out though that if we use 75% of our final value estimate, which I haven't shown you yet, we're constrained to $68 million of loan because we can't go above 75% LTV. The smaller one of these two numbers is what we can support, either the present value of what we can support in terms of payments or 75% of the maximum value of the property. So I put in the smaller of those numbers right there with an if statement, and that's the mortgage that can be borrowed. Now, our loan to cost result is around 68.5%, but if we take this NOI back here, our key number, 7.76 million, and we divide it by a market cap rate, we'll come up with the projected value of $91 million. And notice that the $91 million is in fact below the total cost projection of $100 million if we pay $40 million for the site. So the question is, what's it really worth? Well, we're going to have to put $31 million in change into this if it cost $100 million, and it's only worth $91 million, so the total equity value we create is $22.8 million. In other words, if this number is smaller than this number, we're not creating any additional equity value at all. We're losing $8.6 million. So now if I go back to this number and I put in something smaller, and let's just put in 30 million just to show you how it works. So if we pay 30 million for this site and our total cost are 90 million and we create a value of 91.3 million just as before, we're going to actually have to put in 21.5 million there, but we'll create additional equity value of 1.3 million instantly. So the total equity value is now greater than what we actually put in. The loan to cost is 76%, and it's more feasible. So what's the land really worth? That's one of the objectives here of a spreadsheet like this. What's it really worth? And it could vary because we're uncertain about some of these assumptions. They could be lower or higher, so we need to do some sensitivity analysis. But you can see that it works as a deal at $30 million on this very simple analysis. Now what I would probably do is have to do a more detailed pro forma, but this quick analysis is a really useful way of finding out what land is worth if you have some idea what building costs are, or if you know what the land is worth, how much you could put into the building and make something feasible. It would be a building residual analysis. So you're going to look at the spreadsheet, but I hope that helps explain how to use it.